Hi guys, welcome to another video by Optionables. My name is Saket and in this video we are going to see more about short strangle, iron condor and their adjustment. So this video is divided into 5 parts. So the first part is we are going to understand the rationale behind creating a short strangle. Second part, we are going to understand how exactly to create a short strangle or an iron condor. Third part, we are going to understand what is the rationale behind doing the adjustment. So these 3 things will get covered quite quickly in the first 8 to 10 minutes, post which starts the most important part, that is the adjustment. So in this we are going to discuss about one simple way of adjusting short strangles. There are multiple ways to adjust short strangle, but we are going to discuss about a single way of adjusting short strangle. So this is a very simple way, you won't need additional margin also. And then finally, the 5th part is about where we backtest for the previous 5 months. So we are going to see how exactly the trade would have gone if we had taken any short strangle. So I hope you guys like this video, and if you are finding the content on this channel informative, please do hit the like button, subscribe and share the content with your friends. Thank you so much for joining and see you soon. In this video, we are going to see a basic way of adjusting your positional short strangle trade. So this is mainly used for positional trades. Intraday also you can do, but it's much advisable for positional. So first, before actually moving on to adjustments, so we are quickly going to see a few key things before we move on. The first thing is what is the rationale behind taking a short strangle. The second one is how exactly do you create a short strangle. The third thing what you are going to see is why exactly do you have to adjust the short strangle, and then we are going to move on to adjustment of the short strangle. So we are going to cover the first 3 things quickly and we'll focus the video more on adjusting. So the first thing is what is the rationale behind creating a short strangle. So the rationale is you expect the market to be range bound. So the idea I have here is I am expecting the market to trade in a small range. So let me just open the chart here. So my expectation, let's say this is the Nifty 3-hour chart which I have opened. So my expectation is by July end, Nifty is going to stay between 16,500 and 15,000. So this is my expectation, and since I have a view that market is going to stay between this range, so what I end up doing is I create a short strangle. So it is, you can also create a short straddle if you're thinking the market will be range bound, but here we are discussing about short strangle, so we'll go ahead with a short strangle trade. So now we will come to Sensibull and we will understand how exactly you can create a short strangle. So now when I am creating a short strangle, my lower end expectation is that the market is going to stay above 15,000. So the range is 15,000 to 16,500. So the lower end I expect it to stay around 15,000. So what I'm going to do, I'm going to short a 15,000 put option, right? And the upper range what I expect is 16,500. So I am going to short a 16,500 call option. So I have put July 29th here and I'm shorting 16,500 call option. So you can see that my probability of profit while doing this comes to 77%, and I have my break evens at 14,880 and 16,616. So this is my break even, and this is well beyond my range. So my range was 15,000 to 16,500. So now this is how you create a short strangle. On the lower range, you end up shorting your put option. On the upper range of your expectation, you end up shorting your call option. So now coming to the important part, if you are taking a short strangle trade, that too especially positional trade, never go without a hedge. So always make a point to hedge, because in case of a wild gap up or gap down due to any circumstance, so this hedge leg will definitely be saving you a lot of money. So we are going to go and purchase a hedge leg at 17,000, which is 500 points away. And even on the downside, we are going to go 500 points away and purchase at 14,500. So you can see that by doing this, my loss now gets limited. So before buying the hedge leg, so I'll just show that to you. So before adding these hedge leg, I had an unlimited loss, but with this my loss gets limited. So I know that in the worst case, this is the maximum I'll be losing. So this is the most important part, and this is what you have to understand before actually learning how to adjust, because this is the most crucial part of the video. So first we are going to go through the statistics of the trade. So here you can see that my max profit is 3,785 and my winning probability or probability of profit is 75% and my max loss is 21,215. So what does this mean? So this means that if I am taking 100 trades, I am going to win 75% of the times and I am going to make 3,785. And we are going to assume the worst case scenario. So not always your loss is going to be 21,000, because if the market is ending somewhere here, your loss can only be 4,000. Or if the market is ending somewhere around 14,600, your loss can only be around 13,215. So not always it is going to be 21,000, but so you can see that we are having a very conservative assumption here. That is, whenever we are losing entire 21,000. It might not be the case always. So when I am taking the trade for 100 times, 75% of the times I am making 3,785 because the profit is more or less fixed. Remaining 25% of the times I am assuming that I am losing 21,215. We already discussed why it is a conservative number, because if the market is ending anywhere else, you actually don't end up losing so much, but we'll still assume the same. So now we are quickly going to work out what will happen to us if we take the trade for 100 times. So if we are going to take the trade for 100 times, 75% of the times or 75 trades, I am going to make a profit of 3,785. And remaining 25% of the times or 25 trades, I am going to make a loss of 21,215. So this is the statistics which we saw, which means if I trade for 100 times or 100 trades, this trade is going to give me a profit of 2,83,875, and this is a positive, and this trade is going to give me a negative of 5,30,375. So if I repeat this trade for 100 times without any adjustment, I am going to be at a net loss of 2,46,500 rupees. But here again, as I told you, we have maintained a very conservative assumption that we are always going to have a max loss, but this is not going to be the case. Your actual number will be much lesser than this. So why do we have to adjust, or what is the rationale behind adjusting? The rationale behind adjusting is whenever you are losing this 25% of the times. Imagine instead of losing 21,215, you just end up losing around 7,500 rupees. So now what is going to happen? So now the question is, instead of losing 21,215, if I only end up losing 7,500, if I can restrict my max loss to 7,500, then I am going to lose net of 1,87,000 only. So 1,87,500. So which means I will be left with a positive of somewhere close to 96,375. So without adjustment, if I take the trade for longer run, in the longer run, I'm going to have a net loss. But if I do an adjustment and if I can just cut down my maximum loss, then I am going to have a profit of 96,375 in the longer run. So this is just with one lot what we are talking. We are not even talking with multiple lots. So this is the entire idea of adjusting. So what is that? You are just focusing on cutting down your maximum loss. So if you do that, then automatically you are going to have a positive result. Okay guys, so I am going to teach you now 3 easy steps to adjust the position. So you're only going to do 3 adjustments, and post that you're not going to do anything, because we have already seen the logic behind adjusting the trade. So I'll just write down the positions. We have shorted 15,000 puts, and we have also shorted 16,500 calls, right? So what you have to note here is you're going to do your first adjustment. Nifty is at 15,700 now. So you're going to do your first adjustment only if the market breaches the break even. Either if it comes to 16,500 or either it comes to 15,000, only then you're actually going to do any sort of adjustment. So let's assume that the market comes to 16,500, right? So you're going to do your first adjustment. So what is your first adjustment? You're going to exit this put option. Exit this put option completely and take the average of these two. That is 15,000 plus 16,500 is 15,750. So this is your first adjustment. Exit this put option and you're going to short 15,750 put option and 16,500 call option. You anyways have this, so you just maintain the same position. So this is your first adjustment. So I hope this is very clear. So your first adjustment is when the market moves towards the break even, you're going to exit your leg. When market moves towards your break even, you're going to exit the other leg and come to the average. So average is 15,750. So you're going to short 15,750 puts. So what if the market actually comes down towards 15,000 instead of going towards 16,500? Then you're going to exit your call leg and come to the average. So you're still going to have your 15,000 puts and you're going to come to 15,750 calls. So I hope this is very clear. So this is the first adjustment you will be doing. So post this, you will be only doing exactly one more adjustment and then you're going to stop everything. So this is the first adjustment if the market comes to your break even. So now I am going to clear this. Let's assume that the market has moved up towards 16,500 and I'm going to clear everything. So currently the market is at 16,500 and you have 15,750 puts and 16,500 calls. So now what we are going to do, the market is at 16,500. You're going to keep 500 points as your reference. So this is your reference. So there are two possibilities. Market can either go up 500 points or come down 500 points. So if the market is coming down 500 points towards 16,000, let's say it is going to 16,000, this time you will definitely be in profits. Why you will be in profits? Because this call is at the money and this is completely out. This call is at the money and this is completely out of money. Hence the price of 16,500 will be much higher and you will definitely come to profits. So there is no second doubt about it. And once that happens, once you come to 16,000, exit all the positions in profit. Do not hold any positions at any cost. Exit all the positions. So what if it ends up going to 17,000? So that is another possibility, right? So you're keeping 500 point as your reference. From 16,500, what if it ends up going to 17,000? So this time what you're going to do is you're going to exit 15,750 puts and you're going to create a short straddle at 16,500 completely. So you're going to come to 16,500 CE as well as PE. So you're going to create a short straddle at 16,500. Do not do anything to your hedge legs. Keep your hedge legs as it is because hedge legs are the ones which are actually going to help you in the longer run. Do not touch your hedge legs at any cost. So after this, when do you exit? So when do you exit the trade? So this is the trade you have taken and you have now come to 16,500 short straddle and the market is at 17,000. When do you exit the trade? So I have 16,500 puts and 16,500 calls and market is at 17,000. So now again keep 500 point as your reference. So two things can happen. What if the market ends up going to 16,500? This time again you will definitely be in profits. Why? This is OTM and this is in the money. And when the market falls, you will for sure be in profits. Exit everything at a profit. Do not hold your positions. Exit everything at a profit. But what if market actually ends up going higher? So if the market ends up going higher, don't do anything. Just take the loss. Just take the loss. Do not do anything. Why? Because your loss will get limited because you will be having your hedge leg and you don't have to worry much. Your loss will anyways be limited and there is no need to do any further adjustment. So these are the three things what you are going to do. I am going to repeat it again. So when the price comes to break even, exit the other leg and enter one more at the average. So enter at the average. So second one, so in case of a 500 point move, continuity, exit the other leg and create a short straddle. And in case of 500 point down move, exit all the legs at profit. So this is in case of 500 point down move, exit all the legs at profit. And finally, third one, after doing one more short straddle, now in case if the market ends up coming 500 points down, so this is for 500 points continuity, this one 500 point reversal. So now here in case of continuity, don't do anything. So in case of 500 point reversal, exit all. So I hope this is very clear. Again, go through. First, in case you come to the break even, you're going to exit the other leg and you're going to enter at the average. Next, if the 500 point move continues, then you're going to exit the other leg and create a short straddle. If there is a 500 point reversal, you're going to exit all the legs at profit. And after you create a short straddle, in case if there's again continuity, don't do anything. In case if there's a 500 point reversal, then exit all the trades. So now we will look from January and see what exactly has happened. We are going to backtest everything from January and we are going to maintain an Excel sheet. So let's come to January. So this is the chart of January, and January 1st, we started with around the level of 13,900. So we started with 13,900, and let us say I have a view that, so we are beginning in Jan, right? 13,900. I have a view that the market is going to stay between 13,500 and 14,500. So this is my starting view, what I have on the market. So what do I do now? So let's stimulate and check in Opstra. On January 1st, I am going to sell 13,500 puts and I am going to enter 13,000 calls, because hedge leg is very important, because it will be providing you some protection in case of a huge move, and beyond a point also you don't have to really worry about your loss because there will be hedge leg. And next what I'll be doing is I'll be shorting 14,500 because that was my level. So 14,500 and 15,000. So this is an iron condor and I create that. So when will I be adjusting? Once we touch towards 14,500, I will make my first adjustment. So that is going to be my break even, that is 14,642. That is going to be my break even. Once we touch there, I am going to make my adjustment. So we are 5th of Jan and we still haven't touched. So we further move ahead. Right. On this day, that is, let me come one day back. So you can see that right here on 11 Jan, 3 o'clock, we have touched 14,483. So it is almost end of the day. So let me just go 15 minutes ahead. So 14,486, it's end of the day and I am going to do my adjustment. So what adjustment am I going to do? First adjustment, what do? We are currently at 13,500 and 14,500. So I am going to exit this puts and I am going to come to 14,000 puts. Why? The average of 13,500 and 14,500 is 14,000. So that's the reason I am going to take 14,000 puts. So now let's come to 14,000 puts. So this P is at 38. So I am going to exit this at 38 and I am going to enter 14,000 puts. So here I am going to enter this at 97. So the next condition what we have is, in case of a 500 point up move, we'll be doing one more adjustment. In case of a 500 point down move, we are going to exit everything. So that we are going to see now. So now the market is at 14,588. So till 14,900 and odd, I am not going to adjust. Similarly, till it comes down to 14,050, I am not going to exit. So we are going to see. As you can see, when I did the adjustment, I had 4,000 loss. Currently, I am at a 2,000 rupee loss. Doesn't matter. So now the market starts falling. Again, it goes up. Again, it goes up. and 22nd of Jan, you can see I have come to a 7,000 rupee profit. The market has neither gone 500 points up, neither come down 500 points. And finally, it comes to 13,000. So I will go a little back. So here it is at 13,991 and I am at a profit of 8,833. So it has broken 14,000, which means I am going to exit the trade completely. I am going to note that in January, I have a profit of 8,883 rupees. So this is what we booked in Jan. So now we will come to the month of February. So in the month of February, you can see market is at 13,750. So I am going to take a view that the market is going to stay between 14,500 and 13,250 or 13,200. So I'm going to take 13,200 and market is going to stay between this range. Right. So now for Feb, I'm going to add 13,200 sell. I'm going to sell one lot and I'm going to go to 12,700. I'm going to purchase one lot and I'm going to come to 14,500 and I'm going to sell one lot, and 15,000 I'm going to purchase one lot. What has happened? You can see my break even. I am going to take my first trade when I come close to my break even. So now you can see the very next day I come to my break even. So I have almost breached my break even, and because on the budget day you saw how the market rallied, obviously you will be at your break even and you are starting with a loss of 6,000 rupees. So this is when the very next day you end up doing your first adjustment. Maybe you go another 30 minutes ahead and now you see you have actually crossed it. So before you hadn't crossed. So now you end up doing your first adjustment. So what is your first adjustment? When it crosses your break even, you are going to take the average. So what is my average? 13,200 and 14,500. So I am going to come to 13,850 put option. So I'm going to exit this 13,200 and I'm going to come to 13,850 put options. So let me just do that. So the current price of 13,200 is 32. So exit at 32 and I am going to enter 850 put options one lot. So you can see that every time you do this, you don't need any additional margin. And now again, we will continue with our trade. So if it is going to come back, then we are going to exit everything. If it is going to continue, then we are just going to shift one more. So we will see what exactly happens. So the market continues to shoot up, up and up. So now it is at 15,100, which means it is 500 more points higher and we are at a loss of 14,000 rupees, which means what do we do now? So market has moved another 500 points up, which means we have to now exit the other leg and create a short straddle. So we are going to exit this leg at 13,850. So we will see what is the price. It is currently trading at 36 rupees. So we will come out at 36 rupees. We are going to add 14,500 at 100 rupees. So I'm going to add one more lot. So now I am at a loss of 14,000 rupees. If it is going to come back to 14,500, I am going to exit everything. Otherwise, I am just going to hold it. So I'm not going to do anything. I am going to hold it. In case if it is coming back, I will exit everything. So let's see what happens. So I'll go ahead 11th Feb, 12th Feb. So nothing is happening. I don't have to worry about upside because my hedge leg is giving me profit. So nothing much happens. And so here it actually sort of comes back on 24th Feb, but it is not enough for me to exit. So it has actually not come back 500 points for me to exit. Even though my loss is just 1,900 rupees, I am not exiting because it has not come down 500 points. But later the market just shoots up and I am going to exit the overall trade at a loss of 16,537 rupees. It's absolutely fine. Why it is fine? Because you have higher probability of winning, so you don't have to worry. So my Feb month went with a loss of 16,537 rupees. So I have a loss. So no need to worry. It's just 1 month loss. So we will see what happened in March, April and May. So I'm telling the entire point of adjusting is because you will be reducing this loss. Otherwise, if you had just let it, it would have been somewhere around 28, 29K. Just because you adjusted, your loss is now just around 16,000. So now we will do for March month. Let's say March month, I became little conservative and I had a little bigger range. So market started somewhere around 14,750 right here, and I have a range of 14,000 right over here and 15,500 right over here. So I have this range, 1,500 point range, like how we initially discussed. I have a 1,500 point range, and now let's see what happens. So I will go to March month. So March month, I end up shorting 14,000 puts and I buy 13,500 puts. And here I end up shorting 15,500 calls and I end up buying 16,000 calls. So this is my payoff graph, and you can see my break evens. So now I'm just going to move ahead, and March month, it is never going to come close to my break even also, which means I never end up adjusting the position. So you can see that it never comes close to my break even. Whole time it trades within my break even range, and I end up making 11,085 rupees in March. So my March profit is 11,085 rupees. So in April month, market opened at 14,750, around this range. So let me be a little more aggressive, because if I become conservative and go for 15,500 and 14,000 again break even is not breached and we are never going to get to adjust. So the whole point is we want to adjust the trade, and we will assume we expected the range of 14,250 and 15,250. So this was the range we expected. So I am being very aggressive here. If we take the same range like before, 15,500 and 14,000, we would have never breached it again, and which means again we don't have to make any adjustment. So I'm going to go to 14,250 because I'm going very aggressive this time, and I'm going to buy 13,750, and I'm going to go to 15,250 because I am aggressive, and I'm going to purchase 15,750 calls. So what is the first rule for adjustment? If we go near our break even, we are going to adjust our trade. Okay guys, surprisingly it didn't breach our break even at all. So I came to the end of expiry and still it hasn't breached our break even a single day. So I was as short as 500 points on the downside and 500 points on the upside. So not even once it breached the break evens. So because we entered 250 itself, our break even was around 14,074, which was much lower than 250. So it never breached this break even. So which means we never had to do any adjustment here. So this entire 13,000 is again our profit. So that is 13,196 is the total profit for April. And we are going to do for May. So May, the market opened somewhere around 14,500. So I am going to take a range of 15,000 and I am going to take a range of 14,000. So 14,000 and 15,000 is my range. So we are going to see what happens in May. So here I am going to enter 14,000 puts. I am going to short this and I am going to short 15,000 calls. Purchase the hedge at 13,500 and 15,500. So now you can see my break evens. It is at 13,806 and 15,194. So what we are going to do once it breaches our break even, so we are quickly going to move ahead. Right, so we will assume here our break even is breached, right? It's very close to our break even. So we are at a profit of only 1,300 rupees. We are going to do our first adjustment. Here we are going to exit the trade, that is exit this 14,000 puts. What is the average of 14,000 and 15,000? 14,500. So we are going to come towards 14,500 puts. So we are going to do that right away now. So I am going to exit this at 7.8 rupees and I am going to enter 14,500 puts at 23 rupees. So my next adjustment will be if the market ends up moving another 500 points, I'll be doing the adjustment. If the market comes down 500 points from here, that is towards 14,600, I'll be exiting all the position. So let's see where the market ends up going. So the market ends up moving higher, but it doesn't actually move 500 points. So we come to the expiry and we end with a loss of 6,341. So May, we have a loss of 6,341. So on the first column, what we have is the profit when we, or the results what we adjusted, and on the right side we have the results when we didn't do the adjustment. So we'll be quickly looking at what is the overall result. So when we did the adjustment, our profits for 5 months came to be around 10,000 rupees, and when we didn't do the adjustment, the profit for 5 months came to be just around 1,900 rupees. So this is just on one lot. Imagine you did this on 2 lots or 3 lots. So you have almost increased your profit 5 times just by doing small and simple adjustments. So now we will see the margin required to do one iron condor. The margin requirement for the same is somewhere around 50,000 rupees only. So 44,000 is after the credits you get. It is going to cost you somewhere around 50,000 rupees. So now let's say we'll calculate the percentage of return. So let's say capital required is 50,000. So you can see with adjustments, you have a total return of 21% just in matter of 5 months. And without adjustments, you would have had only 3.9%. And these adjustments are also very simple to do. Only 3 things you have to remember. Just do the shift once it reaches your break even. Then 500 point up move, you are going to make one more shift. 500 point reversal, you are going to exit everything. Then after doing the second shift to a short straddle, 500 point up move or any up move, you are just going to hold the position. 500 point reversal, you are going to exit everything. So this is what we were mainly talking about, that do not focus on making lot of profits, just focus on reducing your loss. So all we have done here is, you can see that when we had a loss of 26,000, that we have just cut it down to 16,000 by adjusting. When we have a loss of 7,000, that we have cut it down to 6,000 by adjusting. Just by cutting down your loss, you have improved your profits. You haven't done anything extra. All you have done is just cut down your loss and you have improved your profits. So this is a simple way of adjusting your short strangle position, and I hope you guys have liked it, and I'll be catching you soon in the next video. Thank you so much.